Okay, Johnny, let's walk through your paper a little bit and show you the things that I would expect and that I'd like you to do in order to get it up to par. Um, you got a pretty good start on some of this stuff, and let's bring the paper itself up. I'll enlarge it here. By the way, I kind of chose to look at it this way. I think it's just quicker than me typing out everything. So, at the very start, you need to, it's okay even to kind of start it like this, but your introductory paragraph or paragraphs, usually just one, needs to tell me what you're going to tell me. Okay, that should be the case with any paper of really any size. Even a 2-page paper, you'd probably have an introduction where you're going to tell the people what you're going to tell them. I know that seems kind of redundant, but that's the proper format, and it's the old introduction, tell them what you're going to tell them, then tell them, which is the body of the paper, and then you need to have a summary or a conclusion where you tell them what you told them. That's good words to remember anytime you're writing a paper like this for future tests or projects or whatever. So then you go through and you give us a bit of history, and that's great. You talk a bit about the industry, okay, and that's fine. You might relate it size-wise, to some of these others would be something that you would add there. But I don't want you spending a ton of time on the industry, so I'm less concerned about that than I am about later on. You talk a little bit about its strategy, although you don't really give me. They've got a very motivating mission statement and vision statement, and that probably ought to be included in there. But here's where you really fall down then, when we get to the financials, and a couple things. One, I asked for the paper to be about a 5-page paper, and you got 2.5. So you've got 2.5 pages to improve your introduction, improve your conclusion, but then a couple of pages to talk to me about the financials of Starbucks. And this is an awesome company that's just really done some cool things. What you have given me here, the only thing that you've given me really is current numbers, okay? And that frustrates me a little bit. I can get the quote here on Morningstar, or I could go to a dozen other financial deals and take a look, and basically there's the quote, there's most of the information that you've given me, boom. Okay, I'm not at all interested in that. It's kind of okay, I guess, to put a little bit of that in if you want to, in the paper. But this is a company that's got just a wonderful and rich history, and including the growth and improved management and efficiency and all those other things that we in business just love to speak of, and this company is just oozing that, and to not talk about that in a financial, business finance paper is a serious. I was trying to think of a volleyball term that I could relate that to. It's went up for you were a setter though, but it's like you went up for a spike and you whiffed, okay. And so we want to really break some of that down, and I'll even kind of show you what I mean. Now this is first page here, and it looks like my computer is stranded again. It tends to do that when I'm running this program, so maybe we'll wait for a bit or two while maybe it'll come back. Boy, okay, it's kind of back. There's come on, computer, work for me, please. But this is a company that looks like it was started in the mid 1990s, so 20 years ago, which is a relatively youthful company, right? Sorry, my computer's just going nuts, so I'm kind of trying to fill a little bit of space here while we're waiting for it to hopefully come back and work. So it's relatively young. I had to go and look at a chart that took us back basically to the beginnings. And at one point in time, Starbucks started, 36 cents. This is all split adjusted because it's had several splits actually, which splits are kind of meaningless, so but you could have bought it at 36 cents. That's what it says right up there when I'm over here. Sorry, can't kind of look at both at the same time. But if you look up on top there, and now it's selling for just about $50. So imagine if you'd have bought 1,000 shares of that, it would have cost you $360 back in about 1995. And today, that same 1,000 shares would be worth about $50,000. Would have been a pretty nice investment, right? Okay, and we get some basic financials here. And again, this is some of the stuff that you provided me, but what you gave me is just so superficial. One paragraph just doesn't cut it, especially when you've got a company that is just as fabulous as this company has been. This is one of those I taught. Actually, it was personal finance. It was before I was teaching business finance, but I taught a semester in personal finance, and we went through and did kind of a fun project where we looked at stocks and we threw darts and did some different things. But one of the companies, I think one of the students had picked out was Starbucks, and I didn't know much about it at the time, but the students, we looked at it in class and whatnot, and at the time I thought, well, that's kind of a compelling company. I kind of like that, and I made the mistake of not investing any money in it. And boy, that was a big mistake, because even since then, that was probably 10 years ago, and even in that 10 years, it's just done fabulous. So I went and I clicked on financials here. I'm in Morningstar, which you probably ascertained or figured that out, and you had to put in the SBUX, SBUX is Starbucks ticker symbol there. Okay, and when I look at this, I like to look at this in a couple different ways. And let's start with dollars, right? I can change from dollars to percentages, which are really cool. Okay, and it only goes back 5 years. And a lot of the financial pages here online that I looked at only go back 5 years. I'm going to tell you, you might want to go to Starbucks if you can and look at their annual reports. If you can go back further than that, we're talking about a fantastic company that's just done a lot of cool things, and even some of the basic stuff, because their history is just so dynamic. But 5 years ago, at about 10.7 billion. The trailing 12 months now is 17.7 billion. So they've increased their sales by $7 billion, or about 70%, at a 10-year period of time. Okay, or 5-year period of time. I'm sorry, that's a 5-year period of time. That by itself is fabulous, but come down here. Okay, so that's about 70%. Here's their earnings per share, and you can look at basic or diluted, either one. And we don't need to spend a lot of time. Usually diluted just means it takes into consideration stocks that are outstanding for stock awards or stock options that company officers might have. So usually the diluted earnings per share are a little smaller than the regular earnings per share. Okay, but in any event, from 64 cents on the basic up to $1.72. So while the revenues increased by about 70% over 5 years, the earnings per share increased by about 3 times, or about 300%, or 250, 280, somewhere's in there. I mean, huge. Okay, you would expect that it would increase by 70%, because that's what revenues did, right? If they didn't get any worse. But not only did this company improve revenues, it also improved earnings per share by substantially more. And how did it do that? That's when I bounce over and I take a look at the percentages and I say, wow, let's take a look here. So revenue, okay, they just change it to 1%, right? But its cost of revenue hasn't really changed too much. It's come down 0.5%. Okay, that's a little bit. Gross profit, though, gone up about 0.5%. So yeah, okay, that's part of it, but that's a relatively small part. But look at their operating expenses. So they've gone from 38.5 down to 34 something, right? So they've saved over 4% in operating expenses. And why? I mean, you can take a look and tell me. That would be wonderful, right? If you look at their annual statements and whatnot. it may be a classic case of with some size comes efficiency, right? There's the law of basic law of economics, law of diminishing returns. As you go up to a certain point, it's wonderful. You get efficiencies with size, okay, and that's possible. And other operating expenses, which I don't know what those are necessarily, but they've gone from 7.5 down to 5.75. So look at that, they're saving better than 4% there and almost 2% there. So better than a 6% in terms of their total operating expenses. On $17 billion, that's $1 billion more that they are making because it has become more efficient. What a wonderful, wonderful thing. Now, I'm going to take a time out here because I want to look at something and I want you to tell me what this is because it's too important to let go. So we see their other operating expenses 7.5, 7.9, 7.3. Oops, 24.25%. What happened in 2013? Their fiscal year of 2013, the companies, because they end their year in September. So something happened there. Okay, that was a big deal. And Starbucks, I don't know if did they buy another company? Did they have to write off some expenses associated with that? Did they close down some sites? Generally, this was not generally. In this case, that had to be an extraordinary event that happened in that year, and you'd be remiss if you didn't tell me about that. Okay, interest expense, kind of had been going down, then bounced back up. Okay, so perhaps they borrowed a little bit of money to do some things. We can take a look at the balance sheet and you'll be able to tell me that. Other income expense, they had a nice little pop here. They went from less than 1% to almost 3% in other income. That's fairly substantial, actually. Okay. Overall, income before taxes, 13.4 up to 21.2, almost an 8% increase. Again, take that on that $17.7 billion in revenue, and you're talking, what, $1.5 billion almost in terms of increased earnings, right? And so they went from 64 to $1.72. Part of that's revenue, but they've made, because of their cost efficiencies, they've made about another $1.5 billion, and they've got $1.5 billion in shares outstanding. That's what this says. So that tells me that $1 excuse me, $1 of this increase is due to their efficiency that they've gained. In other words, their control of operating expenses. It doesn't mean, if we go back and look at the dollars, you'll see that those operating expenses have probably, this was a big year. Remember, we had that unusual number there. Okay, but sales in general, let's just take a look at that, consistently gone up, right? And this would have been a consistent up, except we had that unusual year in 2013, but fairly consistent increases, okay? But the increases, it's been increasing slower than the revenue. That's how you control those things, and what a wonderful, wonderful job of doing that. I still just kick myself that I didn't buy stock in this company. Okay, so dig into that and go back maybe into the history. You should be able to find some more stuff going back to what its revenues were, in 2005, 2000, back a little further. I'm not sure how far back you'll be able to find, okay, but take a look. This says 5 years. The 10 years is only for premium members, so you wouldn't be able to do it here in Morningstar. And I looked at some of the other ones, and for the most part, they only go back 5 years. So my guess is you might have to go back to the annual statements of the company itself, and probably at their website when they talk about investors relations or something like that. Okay. Now I want to take just a quick look at the balance sheet, because there's a couple things on there that perhaps you ought to tell me about too. This one I prefer to look at in dollar signs as opposed to percentages, for whatever reason. They've kind of shrunk the current assets, and they've actually kind of shrunk the total assets. Total assets. Well, they did. Look at that. They went from 11.5 down to 10.7. So here's a company that's driving more revenue. Okay, it's driving far more revenue, and yet they've reduced the size of the total assets. Well, what's that do? golly, that's just great for ROA, which is return on assets. Okay. They've also reduced the overall liabilities. Okay, mainly it was right up here in these accrued liabilities, and that's a big number there. You might want to go back and show me that one in 2000. Ooh, imagine that, 2013. Okay, so that's probably our event that happened, right? So overall, their liabilities without that event have still been kind of creeping up a little bit, but in relation to its revenues and those types of things, it's no big deal. Here, if we'd have just gone along a normal, would have just been slow increases, right? It did take on some debt here. Look at that, 2013 and again in 2014, a little bit of long-term debt. That's kind of interesting because they were 550, 550, 550. All of a sudden, 1.3 billion to over 2 billion in long-term debt. Might have done that to clear out some of the shorter-term liabilities. Might have done it for some other reasons. Okay, we don't know. And my computer's maybe backing up again. Okay. Come on, computer, be nice to me. Additional paid-in capital, just looking if there's anything here. Retained earnings, nice little increase. Again, in 2013, it was kind of funky. Shareholders' equity had a bit of a decrease there. It got back on track. It'd be interesting to know why they decreased assets. And really, other than that strange event, they actually increased their liabilities a little bit. They took on some debt. And at the same time decreased assets a little bit. They may be trying to shrink their balance sheet a little bit, and sometimes they'll do that. So, okay, I hope that gives you a better sense then of some things to write about. Certainly you want to talk about some of these trends and whatnot, but don't just look at the numbers. Go back and look at some of those those annual reports, okay? And you can find the annual reports. Oops, I should have clicked on filings right here, I think. But go back and look at those annual reports. Go back and look at some of the older ones and what's causing those things. Management's discussion of those things can be extremely important, and it's been just a steady improvement year after year. And so it might be a little tough to find that. It's not going to just pop out at you. You're going to have to dig a little bit in those management discussions probably. Okay, but that's what I want you to do. That's the whole idea of the whole program. So I was just looking at thought filings. So financials, we can probably get the last few years of financials here. We'll see. Annual report goes back to 2011, but you can kind of come along. Format, I don't know, that's probably HTML, but that's all right. Just going to see if we go to, so we get the annual report for 2011. Yeah, look at that. You can go back and get the annual reports. You can get it in PDF, which is cool, for 2008. Go back 2005, annual report. Click on that bugger. Let's see if we can get that bugger to come up here. Maybe not. Maybe my computer just doesn't want to cooperate that much today. So we will see. And if it's not coming up, it's, I'm sure, a computer thing, and it's not the fact that it won't come up, right? Or at least I hope. Yeah, my computer's just stuck, so I'll let this drag on for a little bit. But I think I've given you, I hope, enough insight to get you started. My idea here wasn't to give you all the answers, although I certainly, I think, pointed you definitely in the right direction and spread plenty of breadcrumbs on the trail, okay, for you to be able to go in and find some of that information that will make this report an excellent report. Okay, remember it's a business finance, so you got to spend a couple pages telling me about the the finances of this company, and again, not just the numbers. It's don't tell me, if you look up 2005 and tell me that sales increased from there to now by 250%. Well, that's wonderful, but dig a little deeper and see if you can find out why. Is it because of new store openings? Is it because of same store sales? Is it because of a combination of the two, which is exactly my guess. I'd almost be 100% positive that that's what caused it. So take a look at those things and find them. I think I clicked on that. That old annual report might actually be coming up for me, but we might also wait for 20 minutes to do it. So I think I'm going to sign off. 20 minutes is about long enough for you to have to listen to me, and you can go look at those things yourself. So good luck. Holler, email, whatever. If you got questions, email is preferable to phone calls. So I'll be talking to you soon.